Tax credits for offsetting corporate tax liability. An overview. Introduction to tax credits and corporate tax liability. Tax credits are a significant feature of many tax systems worldwide, providing relief to taxpayers by reducing their overall tax liability. Within the framework of corporate tax, taxable persons may be eligible to receive such credits as a mechanism to prevent double taxation on the same income. These credits can arise in specific situations, particularly when a taxable person has already paid tax on the same income, either domestically within the UAE or abroad in a foreign jurisdiction. The provision of tax credits aims to foster a fairer tax system by ensuring that taxable persons are not subject to double taxation on the same earnings. Circumstances leading to the availability of tax credits. The entitlement to tax credits primarily arises under the following circumstances. 1. Domestic double taxation. Taxable persons may encounter instances where they have paid tax on a particular income stream within the UAE before being subject to corporate tax liability. In such cases, the corporate tax system allows for the application of tax credits to ensure that the same income is not taxed twice. This relief mechanism ensures equitable treatment and compliance with principles of fairness in taxation. 2. International double taxation. Taxable persons operating across borders may face the prospect of being taxed on the same income in both the UAE and a foreign country. This often arises due to varying tax laws and the imposition of taxes by both jurisdictions. To address this challenge, the corporate tax framework in the UAE provides for tax credits as a means of alleviating the burden of double taxation. When a taxable person can demonstrate that tax has already been paid on the same income in a foreign jurisdiction, they may be eligible to apply a credit to reduce their corporate tax liability in the UAE accordingly. Mechanism of applying tax credits. The process of applying tax credits generally involves offsetting the amount of tax paid against the taxable person's corporate tax liability. This mechanism ensures that the credits effectively reduce the overall tax payable, providing relief and preventing the undue taxation of the same income. Tax credits may either fully or partially eliminate the corporate tax liability, depending on the amount of tax previously paid and the applicable tax regulations governing their use. Example scenario. To illustrate, consider a taxable person operating a business that earns income subject to taxation in both the UAE and another country. Suppose the taxable person has paid taxes on this income to the foreign country under that country's tax laws. Upon determining their corporate tax liability in the UAE, they can apply for a tax credit equivalent to the amount of tax already paid abroad. This credit is then deducted from the total corporate tax owed in the UAE, reducing their overall tax burden. Significance of tax credits in avoiding double taxation. The availability of tax credits plays a vital role in mitigating the risk of double taxation, fostering a fair and competitive business environment. It ensures that taxable persons are not penalized by multiple tax systems for the same income, promoting compliance and encouraging cross-border trade and investment. By enabling taxable persons to offset their corporate tax liability using these credits, the tax system achieves a greater degree of neutrality and fairness in its application. For more details, contact us.